M. Solomon here. Welcome. Another great presentation to show you, and I really mean this is a great presentation. It's an actual case study. Unfortunately, if you have an attorney and he's telling you something, you have to listen to him, but I'm going to show you where there's something else happening behind the scenes that you're not aware of, counsel's not aware of. I hope the courts aren't aware of it. Anyway, we're talking about the taking a title in advance of a scheduled default case study, fictitious foreclosures under Title 26 U.S. Code Section 751, Constructive Liquidation. I'm M. Solomon. I'm an accountant and auditor and secondary subprime trading specialist. Spent 30 years in the secondary. I know it inside and out. Caution and word of warning, if anybody out there has not spent some time learning the actual practical learning experience, training in the secondary markets, or have experience in the secondary markets, or is properly educated in secondary markets, they don't know what they're talking about. They're making stuff up. If you have not been in the secondary market, get out of this business. You don't know what's happening. I'm going to show you. You're taking people's money and you're wasting it. You may think you know what's happening. You may think you know how to calculate a wrongful foreclosure. You don't, and I'm going to show you why. And if you're somebody who wants to watch the first 5 seconds of this and turn it off, hey, sale, be gone, no problem. This is for serious people that are serious about making an argument, whether you're current or in default or already lost the home to sale. I got some very good stuff I want to share with you. This is an actual case study. Let's go. When the note is canceled, the debt is extinguished at 30% federal withholding. Okay, you can read it. Likewise, when the election for COD income is substituted for a mortgage, the instrument ceases to exist. It doesn't exist anymore. There are no terms to enforce. You can see here the principal tax rule applies to canceled debt. It's clear cut. Under Section 61, a debtor generally must recognize canceled debt as gross income. Well, if they cancel the debt from the commencement, you're going to get a 1099. If you got a 1099, what note did they enforce? Anyone ever asked that? Counsel, you ever asked that? The creditor, by contrast, is generally permitted to claim a Section 165G worthless securities deduction or a Section 166 bad debt deduction, and that's a tax loophole, what the IRS calls genius. They're getting away with something Congress never intended. Continue. Canceling the debt loses the note. It's gone and gains title. They transferred your title in advance of a default that was scheduled, and that is at 30% federal withholding. You can see at 30% a lot. So COD income occurs when a creditor forgives a debt. Look, if you're going to put someone into default and collect the interest on it, put them in default early and let them sit in the house for about 10 years, right? Because they're now separating the interest from the principal, which used to compound, and it made it impossible to sell a loan after someone was in the house more than 6 months. Now they have a separate account. It can also occur when a creditor accepts property in satisfaction of the existing debt. They canceled the debt and took your title. Or where a creditor and debtor agree to modify the terms of an existing debt instrument. That means they took the title, canceled the debt, and then gave you a new loan. They called it a modification. It wasn't. Let's continue. I'm moving fast because people don't have a lot of time. They want the facts. They just want to get to the bottom line. Electronic tracking system used for timing and valuations upon cancellation of debt at 30% federal withholding. So the note signed by borrower was canceled by the election of the lender's successors as nominee. In each case, the lender is the holder who was never in possession, whereas the instrument was extinguished. Nothing to enforce. The lender's creditor is an indispensable party to a commercial transaction for recorded UCC1 lien. Enforceable note was canceled in exchange for consideration. That's treated as a final sale. The income charged to a payor by payor, that means he's getting a write-off, a tax deduction, because he is going to allege that he paid you, a payee, and that was by a servicer. It's not a servicer under 1122AB. It's a paying agent. Look, servicers are therefore a paying agent under 1122AB for the entire credit back from the date of trustee sale to the date of the cancellation. Excuse me. The term from cancellation through sale and back to origination creates the margin of no greater than 30% due to the IRS for federal withholding on COD income. If I'm going too fast, feel free to just go back and read this. The amount charged and paid to consumers is always offset by the amount credited back for a zero balance as of a liquidation or sale. All property sold for zero. The taxpayer Form 1099 is for the amount credited into a depositor's account at origination for the outstanding balance that was carried back from the canceled note and mortgage obligation. So in other words, the creditor's obligation is your basis in the asset and the lien that they could potentially be foreclosing on because your note was canceled in exchange for income. And the income would offset his debt, which means it's a zero transaction. I'm telling you, I did this for 30 years. No conjecture. Well, I got a fraud. I got assignment fraud. I got bailiff fraud. I got, smorgasbord fraud and Swiss cheese fraud. Get out of here. You're not going to win. Courts aren't listening to that gibberish. This is what's happening, folks. All right, folks, this is where it gets good. This is where the conjecture goes out the window and the facts are used to substantiate the case. I'm going to use a payoff demand. Borrower was smart enough to ask for a payoff demand before they went to sale. This is an actual case. I got unpaid principal balance. There it is. Help me audit. Interest per diem, cost per day. Got it. As of what date? 1/1/10. Divide that number by your per diem. What do you get? 4610.5 days, 6 days. So that should take me from 110 to 816.22. Am I right? Help me audit. 816.22. What does that say? No, I'm off. We'll come back to that one. Anyway, I allege that there's a 30% federal withholding on COD income. 30% federal withholding on COD income. So if I take the interest due for a note that was canceled, someone's going to get taxed on that, and the tax is going to be 151,719.22. Am I right? Right there. Slightly off there, but again, why? Why am I slightly off? I'm off about 17 days here. And anyway, so now I'm going to take the amount shown as a restricted escrow balance. No, as an escrow advance balance. You know what that is? Gibberish. Gibberish. Made up. But that is the number, I think, for the borrower's interest paid to date before they told him to stop making payments. Well, when did he get the loan? I'm going to show you how to find out. I don't have a HUD-1. I can't. They can't submit it because the loan was canceled. So I'm going to take the 151,719.22, and I'm going to use an installment of 25,142.08. Why that number? Watch. 1, 2, 3, 4, 5, 6. I'm left with a balance of 866.72. From 151,719, they amortized all the way down to 866.72. That amount he paid in, so he doesn't get credit for it. But that would take me back to when he got the loan. Why? Because 866.72 would be the term. Let me see. That term would take us from 1/1/10 back to 8/18/07. And by the way, look at that. Those are zeros are there for a reason. They don't want to tell you what they're doing. The computer's doing it, but they're left with a balance of 866.72. That's the term. I said, consumer, that takes you from 1/1/10. They told you to stop making payments. He said, that's right, sir. And I said, that takes you all the way back to 8/18/07 when you got the loan. He said, no, sir, you're wrong. I said, what? He said, I got the loan around 7/23, and my first payment started on 8/1/07. I said, 8/18/07, and you said it was 17 days? He said, yep. I said, okay, well, if I subtract 17 days, that's how much I'm off by. It'd be 8/1/07. He said, yeah, close, but no cigar. I said, well, hang on a minute. They're telling you that you have interest coming due as of 7/30/22, and I calculated you could do it too. Take that number, divide it by that, you get 460. I came up with 8/16/22. He said, well, sir, it says 7/30. I said, yeah, we're off by how much? 17. So you see, we got a 17 credit here and a 17-day deduction here. It balances. It balances, done for a reason. Don't ask me why, but we are on track. So someone says, hey, great, so what? Aliens in Roswell, what else? No, this payoff demand reveals a junk bond offering, structured financing scheme by direct investment at 30% federal withholding. That's why we're just off a hair by 866. So you're going to get a 1099 for the cancellation of debt, which means there never was a loan to enforce as of that date. This is a bunch of electronic contrivances, which are part of the Knight Rider system or whatever it is. It's used, and I designed these systems before, so I know. These are designed to make fake foreclosures up. And if you say foreclosure fraud, foreclosure assignment fraud, it's just ridiculous. Notary fraud, my grandfather's signature before he got married fraud. I mean, it's ridiculous. You're not going to win. But this electronic trading system is what's allowing them to create a fictitious foreclosure and then double ding, give you a 1099 for the cancellation of debt. When the debt's canceled, you can't enforce the note or the instrument. And that's what they're doing. And it all would come to play as of 7/30/22. Party would be over. Does that make sense? Without the demand for payoff, I can't help you. And I got to see that final demand for payoff. If you're interested, stay tuned. Lender and its successors, lender, its successors, 1. 1, 2, lender and its successors. 3, and successors by merger and acquisition. I need 3 parties. And this is where MERS is a nominee for lender. If you don't have MERS, I don't care. You have a nominee. So you got the nominee, and you got a lender successor, and you got all successors to lender. That's the lender, its successor by merger and acquisition. In this case, I think we have WAMU and JP Morgan Chase. And another one, I have Bear Stearns and JP Morgan Chase. Now, lender makes a loan at the expense of the existing lien of record. He was never paid off. Why? Well, the existing lien of records are carried back for cash. That cash that party should have received goes into deposit, cash deposited into a qualified savings deposit, for retirees. And at term, the cash is gone, the retiree retires, and guess who paid for it? The merger and acquisition between the bank and the bank that was owed allows the bank who took the money to keep the money, and your home has paid for that individual's retirement. Is this disgusting? I don't know. I'm not here to tell you that it's right or wrong. It's not what I'm about. I'm an auditor, and I'm going to show you what they did. You go to court, and you figure out how you're going to argue this, but I'm telling you that this is not a mortgage. And I'm telling you the IRS wants its money, 30% federal withholding. And they're going to get their money once you get to 1099. And if you allow this thing to go on and on and on as a mortgage, you're not going to have any luck in court. I want you to tell us about your case in the comments section, or send us your servicing statement so we can share it. I don't care about YouTube hits. I want to just see what kind of situations you're up against, and if you have a final payoff statement, we'll be more than happy to do an initial analysis for you. If you want to engage us, we will be more than happy to testify on your behalf. Expert.witness, secondarytradedesk@gmail.com. You can reach me at 202-550-8364. Testifying in a wrongful foreclosure. Testimony includes federal civil rights claims for the 5th and 14th Amendment. We're not attorneys. Only an attorney can represent your rights and interests in property, but we are detailed auditor. We provide detailed auditor analysis. Look forward to hearing from you. Take care.